Welcome to TFN Smart Trading Action Alert. I'm Laura Cadden. So far, 2007 has been a banner year for stocks. After years of lagging behind global equity markets, even U.S. stocks have risen over 30% on average. So have most European and Asian bourses. Shanghai has doubled. Even Japan has scored gains in excess of 20%. But after setting a new all-time high at above 14,000 in July, the Dow Jones Industrial Index entered a new phase of volatility with pronounced downward pressure. The resulting sell-off caused a 6% drop in the benchmark index in less than a week. Other American and global indexes like London, Tokyo, and Frankfurt have followed suit, correcting sharply. Did this mark the end of the bull market? Maybe even the global equities boom of 2007? Will stocks continue on a downward slide, or does the recent volatility have an upside for investors, and especially smart traders? My guest today is J. Christoph Baumberger, executive publisher of the Taipan Group and the chief editor of the group's flagship newsletter, Taipan. So Christoph, you are very well known for your bullish outlook on U.S. stocks and the American economy in general. Has the recent sell-off done anything to change your mind?
Well, Laura, volatility is part of every bull market, and smart traders ideally take profits near the record highs and buy when prices are coming down. So I really am looking at these lows in the index as excellent buying opportunities again.
So you don't have any, you feel confident that this is not the beginning of a prolonged downturn?
No, I really don't. I believe it's a technical correction, and if you're looking for indicators of how other markets have been looking at these movements, if you're looking at Shanghai, for example, you can't help but notice that at the same time the market corrected in the States and in Frankfurt and so on. The Shanghai composite actually set a new record high. Now, I'm not saying that as Shanghai goes, so does the U.S. economy, but considering that the Chinese economy is so dependent on the U.S. market, to have the Chinese market that represents the Chinese economy really set new records as the main customer corrects really provides a little bit of perspective of how you can look at the current numbers games.
Well, let's talk about gold prices for a moment. How do you interpret the behavior of the prices in the last week of July?
Well, that's another case in point. Gold prices have tried to break through major support points on the upside for three times this year, and they failed. The most egregious example of that was that gold prices actually fell right alongside the Dow in the last week of July, even in the same percentage range. Now, according to the bearish mantra, the hard money mantra, there are three factors conspiring to form a perfect storm against U.S. stocks, which are inflation, volatility, and of course the trade deficit. Now, according to that theory, the gold prices should be moving up when stocks are going down. They should be moving toward the prognosticated $800 per ounce, $1,200 an ounce, $4,000 an ounce. And the fact that they actually moved up really indicates to me that gold, after all, as I've always said, is just another speculative commodity that moves with the market and with the stock markets as well at this point.
So do you think the Dow will continue to go up?
I think the Dow is a reflection of the U.S. economy, and if you look at the numbers, they really couldn't be better. We have second quarter GDP growth coming in at 3.4%. Unemployment is at historic lows, below 4.5%. Business investment remains strong. Consumer confidence is at new record highs. Even GM and Ford are suddenly posting profits again. So yes, my belief is that we really are looking at a period of technical volatility. My prediction for the Dow by the end of the year is above 15,000.
Now, this is despite the ongoing subprime mortgage crisis and the drop in residential construction?
I believe all those factors have already been priced into the market, and what we're seeing right now is really we will be definitely seeing fallout, not just in the U.S. markets, short-term fallout for that in the U.S. markets and in international markets like Germany, for example. But overall, I believe most of that has already been priced in what we're really dealing with right now is technical volatility.
So where would you recommend traders look for opportunity?
Well, I believe volatility like that always is an opportunity for profit. So you can profit on the upside and you can profit on the downside, and the most easy way to achieve that is by options hedged plays on select indexes or ETFs. And in fact, we have just compiled a special report just for our subscribers here at TFN, who are welcome to go to the TaipanFinancialNews.com in the investment strategies column and look for our current hedge play on the Dow, leveraging an upside of 15,000 with a downside of around 12,900.
Oh, great. Thank you very much.
You're welcome.
Thanks for being on the show. To read more about this specific recommendation, check out the investment strategy section of the TaipanFinancialNews.com homepage. Join us next week for another profitable opportunity on TFN's Smart Trading Action Alert. For TaipanFinancialNews.com, I'm Laura Cadden.